What's up, everybody? Welcome to Investing Club. Today we're going to be talking about diversification and if you need to diversify your portfolio more or maybe even less. So, first, a quick definition of diversification. It is the process of allocating capital in a way that reduces the exposure to any one particular asset or risk, and it's usually utilized by investing in index funds and or ETFs. And of course, the conventional wisdom on Wall Street is you need to be diversifying. A portfolio of 1 or 5 or even 10 or 20 stocks is way too risky. You need to be owning an index fund that has every single stock in the market, and you need to have a bond ETF, and you need gold, and you need all of these different assets to protect your risk. And as usual, Wall Street is wrong. The reason they say you need diversification is so you give them your money, they convince you they'll invest it for you, and they'll be able to diversify properly, whatever that means. So instead of listening to these people that want to take your money, let's see what some of the best investors in the world think about diversification and if they diversify their own portfolios. I'm talking about these guys right here. Some of the richest people in the world. Let's see if they diversify or if they do something else. So we'll start with Warren Buffett. Warren Buffett is actually a big critic of diversification, and I put a couple quotes from him here. Why diversification is only required when investors do not understand what they are doing. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. And he also says, if good performance of a fund is even a minor objective, any portfolio encompassing 100 stocks is not being operated logically. And this probably sounds like a slap in the face to some people that own the total stock market ETF or the S&P 500 or anything like that, which own hundreds or thousands of stocks. And to say this isn't being logical is the complete opposite of what you hear every day from, quote, investing professionals. So here's Seth Klarman. He's one of my favorite investors, and he says, diversification for its own sake is not sensible. This is the index fund mentality. If you can't beat the market, be the market. Advocates of extreme diversification live in the fear of company-specific risks. Their view is that if no single position is large, losses from unanticipated events cannot be great. My view is that an investor is better off knowing a lot about a few investments than knowing only a little about each of a great many holdings. One's very best ideas are likely to generate higher returns for a given level of risk than one's 100th or 1,000th best idea. And this sort of goes along with Buffett saying you should diversify if you don't know what you're doing. If you have a really good idea about an investment and you have a stock that you know is trading at only half of what it's worth, it makes no sense to only put 10% of your money in that stock when you could put all of your money in that stock and effectively double your entire portfolio. Okay, and next up we have John Maynard Keynes. And Keynes is not an investor, he's actually a famous economist. And even though economists are wrong about a lot of things, he actually gets this one right. So let's see what he says. He says the right method in investment is to put fairly large sums into enterprises which one thinks one knows something about and in the management of which one thoroughly believes. It is a mistake to think that one limits one's risk by spreading too much between enterprises about which one knows little and has no reason for special confidence. And he was an economist a while ago. So this isn't some radical idea that you shouldn't be overly diversifying. And another one to illustrate that is even Mark Twain had this in one of his books, sort of a sort of parable. Behold, the fool said, put not all thine eggs in one basket, which is but a manner of saying scatter your money and your attention. But the wise man said, put all your eggs in one basket and watch that basket. So again, just to show that this isn't a new idea, this is something that people all throughout history have known. And when you study some of the richest people in the history of the world, they're not diversified. They have all of their wealth in a couple investments that have done extraordinarily well for them. And now we can get to what's actually wrong with diversification. So the problem with overly diversifying is nicely summed up by this graph here. And what this graph basically displays is the amount of risk you're taking on based on how many different stocks you own. And on the y-axis, we have the standard deviation. So that's basically how much variation, or you could call it volatility, is in your portfolio. And you can see when you have a very low number of stocks, the standard deviation's high. And as you add more stocks to your portfolio, the risk falls. And this keeps going, but you notice an interesting thing. Once you get to around 20 stocks, adding even more stocks doesn't change the risk at all. And this is something called systemic risk, which is basically just the risk of the market as a whole. And what this graph is telling us is you could own 20 stocks or you could own 2,000 different stocks. your risk is going to be the same. And this is why in market crashes, you could be diversified and still lose 50%. In 2008, you could have this total stock market index and you could own every single stock and your portfolio would drop 50% because of this exactly right here, the systemic risk. This risk doesn't go away no matter how many stocks you own. And another thing to note about this graph is that portfolio standard deviation is not necessarily a bad thing. In this graph, they essentially equate it to risk, but what standard deviation means is just the amount your portfolio can go up and down. So when you think about it, you actually need some standard deviation in your portfolio if you want to make above average gains, right? If you want to make 15, 20, 25% a year, the standard deviation in your portfolio is going to have to be higher than that of the market. So another thing that this graph illustrates for us is as you add more stocks, as you diversify more and add more stocks, your possible return actually decreases because the standard deviation of your portfolio goes down and therefore won't be able to move up or down as much. And again, this is a double-edged sword because for every extra percent your portfolio could go up, it could also go down. This is why you need to have a sound investing strategy. And if you know what you're doing, you can use this extra volatility to your advantage on the upside instead of losing extra money. So just to sum up, diversification actually increases your risk compared to buying a stock with a margin of safety. And again, that's the most important part, which we'll go over on the next slide. And diversification also reduces your potential for return since one stock outperformance is diluted by many other stocks that are lagging, right? That makes sense, right? If you have one stock that doubles and you have 50 other stocks that go down 5%, and they're all equally weighted, you're not going to make much total return. All right, so if diversifying doesn't actually reduce your risk, what is the best way to reduce your risk? And this is simply buying stocks when they only come with a large margin of safety. And if you don't know what a margin of safety is, that basically means buying a stock for less than what it's actually worth. To use a simple example, if there's a stock trading for $5 and you take a look at its balance sheet and you see that there's $10 worth of equity per share, you know that the stock's worth $10 at least. And if you buy that stock at $5, you now have a 50% margin of safety, which insulates you from risk. This is probably one of the most important concepts of investing that no one really talks about. If you do this correctly, using a margin of safety will insulate you from almost every problem people have about the stock market being risky. For example, a margin of safety will insulate you from being wrong about an investment. So say you are wrong about an investment and it's not actually worth as much as you think it was because you bought at a price so discounted from what your calculated value was. Even if it's not that much, you still won't lose money. In addition, even if the stock drops, again, if you buy a stock at a true 50% discount, the odds are it's not going to drop much and experience little to no volatility on the downside. In addition, a margin of safety will protect you from the business itself failing. So, if you buy a stock at a 50% discount and they cut their sales in half the next year, you're still okay because you bought it so cheaply. The price you paid now reflects the value. So you actually, in reality, you won't be losing any money compared to if you buy a stock at full, what is truly valued, and then it cuts its profits 50%, and then it starts making 50% less money. And then in that case, your investment falls 50% because the company is worth 50% less. Okay, so we've seen Warren Buffett's quotes about diversification, and now we can take a look at his portfolio to see if he actually practices what he preaches. And this is his portfolio as of 2019. And you can see there are many stocks, but the thing to note is that we have Apple, Bank of America, Wells Fargo, Coca-Cola, and American Express. And these 5 stocks make up around 50% of his portfolio. And because Berkshire Hathaway is such a large company, of course, he can't invest only in 5 stocks. But this shows that he's placing a heavy bet on these 5 companies that he believes they're undervalued and will give him good returns in the future. So in this, we can see Warren Buffett definitely is not very diversified when you have 50% of your portfolio in only 5 stocks. The conventional financial advisor would say that's way too risky, but here we have one of the richest people in the world doing exactly the opposite of what kind of advice he would get on Wall Street. This is something Warren Buffett's been doing his whole life. I'm reading a book about him right now. And when he first started investing, I read something that said at one point he had 3/4 of his net worth in Geico stock. And you might know that he owns all of Geico now, but that just shows how Warren Buffett built his fortune, not diversifying, but making big bets on companies where he believes he's buying way below what they're actually worth. So with all this information I showed you, what can you take away with it? How many stocks should you actually own? And there's no right answer for everyone. The biggest thing is you should only own as many companies as you can keep up with weekly or even daily. So when you invest in a company, you should act like you own 100% of the business. You should act like it's only your business and the CEO and all of the employees work for you. And what that means is you should be reading all the annual reports, listening to all the conference calls, and keeping up with anything the CEO says or any news articles about the business, because this is what you would be doing if you own the entire thing. And again, going back to some of the quotes I showed you, what's the point in spreading your money around if you don't know what you're investing in? You can invest in the S&P 500 index fund, but do you actually know all 500 companies that you're investing in? I know I don't know all 500 stocks that are in there, right? And I'm sure even though there's some great companies in the S&P 500, I'm sure there's a lot of crappy ones too. Second, only invest in a company if it's trading at a discount. If it's not, find another stock or wait. This is probably the most important thing. You could be buying the best company in the world, but if you pay too high of a price for it, you're not going to make a good return and you'll actually end up losing money. Just ask anyone who bought Cisco in 2000. It was a very solid company, but just so ridiculously overpriced that people that have been holding for 20 years still haven't made their money back. From what I've seen, most people can only thoroughly research and keep up with 5 to 10 stocks at most. And for me, right now, I only own 3 stocks in my portfolio. And this is because I found 3 stocks that I believe are 50% undervalued, and those are the ones I bought. And to me, it makes no sense to spread out my money into different investments when I have a strong belief that these 3 will outperform any kind of diversified portfolio I could put them in. And again, the key thing to remember, the more stocks you own, the more risk you take on, and the less potential for high returns you have. But remember, this only applies if you're buying stocks with a huge margin of safety. And the fact is, there's not that many of these stocks out here right now, with the market at all-time highs. So in cases like this, it might just be best to wait until a stock you're watching falls and gets into an attractive price for you to buy at. So that's it for this video. Hope you learned something. Be sure to subscribe and leave a comment. Have a great day, and I'll see you on the next one. Peace.